I'm Todd Rosenbluth, Head of Research at Verify, and welcome to another episode of ETF 360. Today, I'm excited to be joined by Andrew Beer, and we're here to talk about Managed Futures ETFs, DBMF. Andrew, thanks for joining me.
Todd, thank you for having me today. And again, I apologize. I know it looks like I've been trapped in a dollhouse, but I'm staying in a cabin in the Adirondacks, and it's great to be able to join you today. Thank you.
It's my pleasure. ETFs trade intraday regardless of where we're located. And what we've seen in 2022 is that advisors have really been interested in managed futures-based ETFs. What do you think has been driving that?
So I would say two things about that. The first is that, yes, there has been an increase in demand. And in our ETF, DBMF, we've seen assets grow from 65 million to somewhere between maybe 430 million or so as of today. And the demand has really been driven by the fact that during the first half of this year, the whole managed future space did really well. So overall it was up over 20%. During a period where the S&P was in a bear market, bonds were having a historically bad year, 60-40 portfolios overall. So I think you have thousands of advisors out there who are saying, where can we get diversification? And just because of the performance, it's leading a lot of people to manage futures.
So what role do you think managed futures play within a portfolio that advisors aren't getting from their traditional equity or fixed income sleeves?
So managed futures has two very, very powerful diversification benefits. And what we say about managed futures is that it has more diversification bang for the buck than almost any other strategy you can find. Why? The first is that it has zero correlation to stocks and bonds over time. Right? And so if you say that to somebody who builds model portfolios, they get really excited because that means that over a long period of time, your volatility probably comes down a little bit, maybe it improves your returns, et cetera. So the quants out there who build models love that feature. What got us really interested in this space is what's called crisis alpha. It's the fact that the strategy was up 20% this year when you needed it. It was up 20% before fees during the great financial crisis. It was up 40% during the dot-com crisis. So if you have something that has low correlation over time and does the best when you really need it the most, it should be in everybody's portfolio. The remarkable thing, back to your early question, is almost nobody owns it in the ETF world. That the entire managed futures ETF space, of which we're somewhere about maybe 40% of it at this point, is $1 billion. That's 0.01% or 0.02% of the overall ETF world. And I think the reason for that is a couple things, but I think part of it is also just on the education front. I think people who build and run these products haven't really found a good way to explain them to the much broader audience. And that's, what I hope will be part of our legacy over the next few years, is really trying to make a dent in that.
So let's do that. Let's talk about the way that your ETF is constructed.
So we believe that in any hedge fund strategy, or I should say most hedge fund strategies, but particularly managed futures, it's really a few big trades that matter. And so how are these guys up 20% this year? And we were up, I think through June, we were up maybe 25%. It's because they got inflation right. And they were early on inflation, and they rode the trade. And there were three different legs of it. One was, were you long oil at the right time when oil went up? Were you short treasuries when rates kept going up? And also, were you long the dollar against key currencies? Those three things, it's not that complicated, but you have to find a way to find out how these really smart guys are putting on these trades and when. And so our whole business is something called hedge fund replication, in that we're not trying to be smarter than the smartest guys who do this. Rather, all we're saying is if we can use our own ways of figuring out how they're positioned, copy it cheaply, and put it in an ETF, we can transport the benefit that they provide to institutional investors and billion-dollar family offices and bring that to the much broader asset management world that invests through ETFs.
So one of the other benefits from the ETF is that it's actively managed. Let's just talk about how that makes this different than perhaps an index-based managed futures ETF.
So there are no. It's a great question. I think there's a great deal of confusion around it. There is no index like the S&P 500 that you can invest in and get exposure to managed futures. In the same way that if you go into the value world and you say, here's this value index and that value index, somehow these guys have the same name, but they're 20% apart each year. And so in managed futures, when people say, how did managed futures do last year? again, there's no S&P 500 that you can invest in. Rather, what they're saying is, how did 20 or 30 or 40 guys who pursue this strategy, how did they do on average? So because there's no index in this, there is no way to really vanguard the space. The closest you can get, we believe, is by doing what we do, which is if you can identify the big trades of a large pool of the biggest managers, you get as close to an index as you can. The reason we're called an active fund is that we are not creating our own index and following it. Rather, we're trying to follow the broader index of the space. And so you get very, very close over time, but it has, I think, probably the most important added features. You tend to do a lot better because when you take something that's expensive and you cut out a lot of fees and expenses, you just tend to do better over time.
Well, that's true. Cheaper is often better. Andrew, thanks for the time. Thanks for sharing insights about DBMF. Hope folks learn more about it at our ETF Trends platform. Have a great day.